All right, welcome to Talk Tickers. Today, we're digging into the Q3 earnings for a really interesting company, Illinois Tool Works. Let's get right into it.
Okay, so let's dive right in. ITW's third quarter was, well, it was a classic mixed bag for investors. On one hand, you've got a solid beat on earnings per share. They hit $2.81. But on the other, they came up just a little short on revenue, landing at $4.06 billion. You know, it's one of those results that really makes the market scratch its head and decide what story matters more. And boy, did the market pick a side. The reaction was not great. The stock closed down for the day. So that's the big question we're asking here, right? How does a company with record-breaking profits end up with a stock price in the red? What's going on?
All right, to really get the full picture, let's break this down. First, we'll look at the good stuff, the bull case. This is all about their amazing operational performance, which is exactly what drove that big earnings beat. And you can bet this is the story management was really hoping investors would listen to.
So the first number that just jumps off the page, 27.4%. I mean, wow. That's a record operating margin for the company. It's a huge signal that their operations are running like an absolute well-oiled machine.
And look, this wasn't just a small bump. We're talking about a 90 basis point increase compared to last year. That's a big deal. For anyone new to this, a basis point is just 1/100%, so 90 is a really healthy jump. Management pointed straight to their enterprise initiatives for this success, especially that famous 80-20 strategy of theirs. You know, where they laser focus on the top 20% of their customers who bring in 80% of the business. Clearly, it's working.
And when you're that efficient, what happens? You generate a ton of cash. This operational excellence translated directly into a massive pile of cash, a staggering $900 million in free cash flow just for this quarter.
Here's the bottom line on that. They are incredibly good at turning the profit you see on paper into actual spendable cash. When your free cash flow conversion is over 100% of your net income, that's just a gold star sign of a super high-quality, exceptionally well-run industrial company. It doesn't get much better than that.
And check this out. It wasn't just one part of the business getting lucky. The strength was broad. 6 out of their 7 segments actually expanded their margins. I mean, look at some of these standouts like Auto OEM and food equipment, just posting killer profitability.
So with all that cash piling up, what they do, exactly what you'd expect from ITW. They continued their long tradition of giving back to shareholders. We're talking $375 million in share buybacks. And get this, they raised the dividend by 7%. That makes it their 62nd year in a row of dividend increases. 62! That's just incredible consistency.
Okay, so everything sounds great, right? Record margins, tons of cash. So why the long face from the market? Well, let's flip the coin over and look at the other side of the story. This is where we shift from what the company controls inside its 4 walls to what's happening out there in the real world.
Because despite all that amazing profitability, the top line, the revenue, was telling a very different story. Organic revenue growth, that's the real apples-to-apples growth, came in at just 1%. 1. For a company of this quality, a number like that is going to make people nervous.
And then came the guidance for the rest of the year. Management tightened up their forecast. Now, on one hand, narrowing the earnings range shows they're confident they can hit their profit targets. But the big reveal was the outlook for growth, now sitting at basically 0 to 2%. That pretty much confirmed everyone's fears. They see a slowdown coming.
So there you have it. This is the setup for that big disconnect we saw on earnings day. You've got this fundamental clash between the story management was trying to tell and the story the market was actually paying attention to. It's really a tale of 2 different perspectives, isn't it? Management was shouting from the rooftops about their amazing internal execution, the margins, the cost controls. But the market, they were just staring at the top-line numbers, worried about slowing growth and that cautious outlook. At the end of the day, the market was way more worried about tomorrow than it was impressed by today.
And you can literally watch this play out in the stock chart for the day. The negativity started the moment the press release came out at 8 a.m. And then, as the earnings call went on and management started talking guidance, the stock just kept heading south.
This really sums up the whole tug-of-war, doesn't it? On the left, you've got everything management can control, their internal programs, their discipline, how they spend their cash. But on the right, you've got what the market is worried about, all the stuff they can't control, like the overall growth rate and what the economy is going to do next.
So where does that leave us? What does all this mean for ITW going forward? Okay, here's our take on it.
Look, our thesis here is pretty straightforward.
ITW is, without a doubt, a top-tier industrial company. The question isn't about their quality, it's about how fast they can grow. And because of that, we're giving it a market perform rating. Basically, we think the stock is going to be stuck in a trading range for a while. The company's quality will keep it from falling too far, but the lack of a real growth story is going to cap the upside. A few things we're going to be watching like a hawk are how they handle tariffs, if the auto segment can stay strong, and of course, any clues they give us about 2026 on the next call.
And as always, just a quick reminder, this is not financial advice.